Hi, this is Jack Crooks from Money and Markets TV. There's a lot of debate about what moves global currencies, and I don't think anybody has come up with a definitive answer. But George Soros summed it up best when he said that currency markets are driven by real people based on their best guess of what future currency prices will be. In other words, expectations create price trends. And it doesn't matter if these trends are based on flawed expectations or a focus on the wrong underlying fundamentals. What's important is that higher prices beget higher prices. Think about it. If a trader bets on a currency rising, for whatever reason, and the currency does rise, the trader will have growing confidence in his rationale, so he'll commit more and more money to the trend. In effect, collectively, traders are creating a self-reinforcing price cycle that may be detached from the actual fundamental reasons for the move in the underlying currency. That's precisely why we tend to see what's called overshoot more in currency markets than we do in other markets. The rationales for moving currency prices are often hard to identify. There's no income statement, balance sheet, or cash flow available to evaluate a currency, as there is with a stock, for example. But it's only a matter of time before a currency gets so far out of line with its underlying fundamentals that people riding the trend start to recognize the disconnect. This recognition sets the stage for a correction. It's what Soros called a boom-bust cycle, and for those traders who position themselves correctly before the change in direction, it could make for a very nice ride. To put it in simple terms as I can, sentiment drives the currency market. Don't get me wrong, a lot of factors come into play. Budget deficits, trade deficits, industrial production, interest rates, inflation, deflation, war, housing, Asian bank reserves, etc. And if you have a good handle on all that stuff, it certainly helps. But if you're not a professional economist, you can still win in the currency markets because there's one rock-solid rule that almost never fails. Extreme consensus plus extreme speculation equals extreme price. And extreme price means it's time for the trend to reverse. When you can identify that extreme, it's a great opportunity to get on board early and position yourself in the opposite direction. There are a couple of different ways to gauge price extremes. One good method is to follow the price action relative to the background news. For example, if Australia reports that job growth soared, but the Australian dollar still traded lower, there's a good chance that something is going on that we don't know about. There's some other reason for the selling pressure. That's the nature of markets. They often give us clues about the underlying fundamentals before these fundamentals are widely known. And that's why this simple indicator has stood the test of time. I also like to look at sentiment, the collective wisdom of the market, because like I said, after all the sophisticated analysis, it's still irrational human beings driving the markets, making decisions to buy and sell based on their expectations, needs, fear, and greed. Price action and sentiment are just two factors that I rely on to make trading choices. And I highlighted them because they're indicators that anyone can incorporate into their trading toolbox. But in the coming weeks, I want to discuss my trading strategies even more and tell you about the other factors I consider when determining my currency equation. I'm Jack Crooks from Money and Markets TV. Thanks for watching.